Hey everyone, and welcome to This Explainer. Today, we're diving into something that can literally change your life, building long-term wealth. If you've been looking for a clear, no-nonsense way to make your money actually work for you, well, you're in the right place. Let's jump straight into the source material and demystify the financial markets once and for all.
So have you ever wondered why some people just seem to effortlessly grow their money while others are constantly struggling? It is super easy to assume this secret is just pure luck, right? Or maybe a massive inheritance. But the source material points to something entirely different. They simply understand how investing works. Investing is honestly one of the absolute most powerful tools we have for building wealth over time. And the best part? Absolutely anyone can learn how to do it. A really great way to think about investing is to compare it to planting a tree. Think about it. If you put a tiny seed in the ground today, you obviously don't wake up tomorrow to a giant oak tree, right? You gotta water it, protect it, and most importantly, you just have to give it time to grow. Well, investing demands that exact same level of patience. The earlier you start and the more patient you are, the more massive your financial tree is ultimately going to become. Section 1. The soil, saving versus investing. All right, let's lay down our foundation by comparing two very different financial habits. First, saving. Saving means putting your cash in a super safe place, like a traditional bank account. It stays there, it's totally protected, but it grows really, really slowly through basic interest. Now, investing, on the other hand, means actually using your money to buy assets that have the potential to go up in value over time. We're talking stocks, bonds, mutual funds, real estate, you name it. And yeah, investing definitely involves some risk, but it's exactly that risk mechanism that gives you those much bigger opportunities for real long-term growth. Moving on to Section 2, the seed, the magic of compound growth. Now, before you start thinking you need an absolute fortune to even begin, I want you to focus on this number, $100. Seriously, you do not need thousands of dollars to become an investor. A totally approachable amount, like investing just $100 a month consistently, is literally all it takes to get in the game. To really drive this home, let's look at a quick story about two friends, Emma and Jack. Emma decides to start investing $100 every single month starting at age 25. Jack? Well, he waits until he's 35 before he starts investing that exact same amount. Even though Jack goes on to invest for many, many years, Emma ends up with drastically more wealth. Why? Simply because her investments had a 10-year head start. That's it. So the exact mathematical reason her financial tree grew so much larger comes down to one absolute game changer of a concept: compound growth. This basically means your initial money earns returns, and then those returns begin earning their own returns. It is essentially a snowball effect. And over the years, this compounding creates truly amazing exponential growth. It's almost like magic. Section 3, watering and protecting, risk and diversification. Okay, let's reframe a word that honestly scares a lot of beginners, and that word is risk. Risk just means there's a chance the value of your investment could go down. It's really not some monster hiding under the bed, it's just a fundamental part of the whole process. In fact, taking reasonable risks is often absolutely necessary if you want to achieve those better returns we were just talking about. The real secret here is just understanding your own personal comfort level. If seeing your account balance bounce around makes you incredibly nervous, well, you'll probably want safer investments. But if you have a long timeline and can handle a few bumps in the road, you might choose investments that have a much higher growth potential. So how exactly do we handle that risk the smart way? The answer is diversification. This is a vitally important concept. It simply means spreading your money out across different companies, different industries, countries, and asset types. The goal here is super simple. You're actively reducing your risk while still allowing your money the room it needs to grow. Think about it, using that classic analogy of carrying a bunch of eggs. If you put all your eggs into one single basket and then you drop it, total disaster. But if you spread those same eggs across 4 different baskets, dropping one isn't going to ruin everything. Smart investors do the exact same thing to protect their financial tree. Section 4, smart beginner strategies. All right, here is a highly actionable roadmap pulled straight from the source. Step 1, build an emergency fund. Look, life is completely unpredictable. Having a few months of living expenses safely saved up means that if you get hit with a surprise medical bill or maybe lose a job, you won't be forced to sell your investments at a really bad time just to survive. Step 2, set clear financial goals. Are you saving for retirement, a house, total financial freedom? Having a clear why keeps you focused on the prize. And finally, step 3, buy broad market index funds or ETFs. For most beginners, these are incredibly effective. Instead of trying to guess which one specific company is going to win, these funds let you buy tiny little slices of hundreds or even thousands of companies all at the exact same time. You're basically buying the whole market, which naturally diversifies your portfolio for you. Now, once you know what to buy, how exactly do you buy it? Let's demystify a bit of financial jargon here: dollar cost averaging. It sounds fancy, but it simply means you invest a fixed amount of money on a set, regular schedule, say that $100 every single month. And you do this regardless of whether the stock market is soaring sky high or crashing down. Instead of trying to perfectly time the market, which, by the way, even the Wall Street pros fail at, you just stay incredibly consistent. Over the long haul, this beautifully simple approach smooths out the impact of all those crazy market ups and downs. Section 5. Weathering the storm. The investor's mindset. Let's quickly fire off a few essential rules for long-term success. First up, do not let your emotions take the wheel. When markets fall, people tend to panic and sell. When they rise, people get greedy and buy at the absolute peak. Smart investors, they just don't do this. Second, stay patient. Keep laser focused on those long-term goals we talked about. Third, always watch out for investment fees. Even tiny, seemingly harmless fees can eat a massive hole in your compounding returns over the decades, so keep those costs as low as possible. And finally, keep learning. Read books, follow trusted educators, and just stay curious. In this game, consistency matters so much more than perfection. You don't have to be a financial genius overnight. You just have to stay diversified, keep your costs low, and remain patient. I want to wrap up this explainer by leaving you with a really powerful thought from our source material. It says, the greatest investment you can ever make is not only in the stock market, but also in yourself. Honestly, that hits the nail on the head. Build those good financial habits and stay disciplined. Remember, every single expert investor out there was once a beginner who just decided to take that very first step. So what's it going to be? Are you going to let another 10 years of compound interest just slip by? Or is today the day you plant your seed? Keep learning, and I'll catch you in the next explainer.